Geopolitical conflicts often bring significant uncertainty to the financial markets. The recent tragic terrorist attack in Kashmir and the subsequent military response have once again brought such concerns to the forefront. While such events may cause short term volatility, Indian markets have typically realigned with underlying macroeconomic fundamentals over the medium term. I am Sandeep Solanki, product specialist, and I am joined today by Mr. Anurag Mittal, our head of fixed income. Today, we'll walk you together through the key trends, current market dynamics, and the emerging opportunities in the fixed income space. After Anurag's presentation, we'll open the floor for Q&A session. You can submit your questions anytime via the link shared during the webinar. Let's begin. Over to you, Anurag.
Thanks, Sandeep, and good day, everyone, and thanks for joining in UTI Fixed Income Market Insight for the month of May 2025. So last month, the month gone by was a very eventful in terms of, the way global growth outlook shifted, as well as Indian bond market conditions, they kind of shaped up thanks to liquidity infusion by RBI. So we'll break down the various dynamics and what it means for fixed income market and what it means for us as investors. And we'll start from our global outlook and then we'll come back to domestic trends. So broadly, last webinar, we had discussed how the rise in policy uncertainty, especially related to trade and tariff, was, driving a lot of business uncertainty, and it was holding back the capex decision of many firms, and that's now reflecting in consumer sentiment as well as overall economic outlook. So if we look at on the left hand side, we have the global economic outlook forecast by IMF. And as we can see, compared to the last projection, which was made in January 2025, the overall global growth has been shaved off by 0.5% from 3.3% in January to 2.8% for 2025. And if you look at 2026, that's also been shaved off by 0.3% from 3.3 to 3%. If you look at the major, places where growth has been shaved off, it's a US which has been downgraded from 2.7 to 1.8, and even for 2026 from 2.1 to 1.7. Euro region, probably the slowdown is slightly lesser due to announcement of fiscal stimulus by Germany. Even if you look at the second biggest economy, which is China, they are also facing a significant growth forecast cut due to the tariff war going on with the US. Even India has seen some amount of, cut in growth forecast due to this export uncertainty we may face due to overall trade fragmentation. What's also happening on the consumers' sentiment, as we can see on the right-hand side of the slide, the US, whether it's Eurozone or whether it's China, the consumer sentiment has also dropped sharply because as firms hold off their spending plans, it also affects the kind of wage growth they are able to pass on to their employees. It also affects the job market, and even hiring plans get frozen, which in turn leads to consumer spending also slowing down, and that's what's happening. And that is a whole 360-degree the way economy, or the economic engine stalls. So that's how the tariff uncertainty is creating a kind of self-fulfilling economic slowdown. But typically what happens in these cases, whenever there is a risk of events, the kind of situation we saw in April, where on the eve of Liberation Day, that is 2nd April 2025, the US imposed reciprocal tariffs. There was concern that probably US growth will slow down and global growth will slow down, and probably global inflation will also come down, because as US and China engage into a tariff for all those goods which has very high capacity in China will find other markets and probably there will be a positive supply shock from China or deluge of goods which will lead to overall global disinflation. So you have a period of slowdown, you have a period of global slowdown in inflation as well, and you have high economic uncertainty. Typically, during these situations, what we have seen is dollar tends to uh, do well, and typically during these situations, also you are, you know US yields tend to outperform other advanced economy yields, but the opposite has happened. As you can see from the slide on the left hand side, dollar actually has depreciated against major currencies. And even if you look at on the right hand side, uh, the various benchmark 10-year bond yields, they have actually outperformed uh, US 10-year, apart from Canada, which was facing a very unique situation due to the elections they were facing in May. So if you see the traditional correlations between the risk aversion and bond yields or dollar performance have broken in the near term. And what is leading many commentators to call, the fading of U.S. economic exceptionalism, which they were expecting post elections of Donald Trump. So, what was U.S. economic exceptionalism all about? So, when the new administration was just taken in, so if you can see the first again left hand slide, and if you see Q4 CY24, most of the other currencies had depreciated against dollar. So whether it's Swiss franc, euro, yen, pound, or Canadian dollar, they all had depreciated against USD. And if you look at the bond yields on the right hand side, they all had gone up in lockstep with the US 10-year bond yield as well. So why did that happen? One of the major reasons why the currencies depreciated against dollar was the expectation that probably as the new administration would come in, they will deregulate the businesses, the tariff measures may not be as harsh, and there will be some tax cuts on the corporate and individual side. So a combination of consumption stimulus and business deregulation will lead to stronger economic growth in the US. That will also delay any major Federal Reserve easing as well. And that was the reason why dollar went up and US 10-year also went up, because the reason was that US will grow faster than the rest of the comparable advanced economies. And that was the US economic exceptionalism. And how that has unraveled since 2nd April 2025. The reason is uh, not too many market participants were expecting the kind of tariffs the US put out on the rest of the world. As we discussed in the previous webinar, the US tariff regime has gone back to 1909 tariff levels, where tariffs were about 23% of value of imports compared to 4% they were before 2nd April 2025. So given the high tariffs that now market participants saw from the US, the expectation of high economic growth in the US totally flipped on its head. And in fact, now market participants are expecting higher inflation and lower growth in the US compared to the rest of the world, because all that China capacity will probably flow to the rest of the world and may result in lower inflation compared to the US, because US will still have higher tariffs. Secondly, because of this high tariffs and high economic uncertainty, now probably uh, you know investors, especially foreign investors, may slow down their inflows into the US financial markets, and that led to a rise in bond yields for the US compared to the rest of the world. So if you look at now on the red bars on the right hand side, while US yields went up, all the other advanced economies such as Germany, UK, Japan, Australia, etc., they in fact went down. Like I explained, the only exception was Canada because that was due to local elections, but the broad direction is quite clear. And so it begs us to a question: is really US fading out? Does it mean in the long term, the typical market behavior, which was buying US dollar assets in times of economic uncertainty, going out of favor? Second, does it mean that US dollar reduces to be a global anchor of the world monetary policy and the world monetary system? Probably the answer is slightly more nuanced. So if you look at this left-hand side of of the chart, uh, and if you look at the blue line, which is you know uh, the trade-weighted US dollar index, and you look at the amber line, which is the USD share of global FX reserves, which also include gold holdings. Uh, Typically, US dollar has been seeing a declining pattern as part of reserves since 2015. So if you see after being close to about 60% in 14-15, US dollar has been consistently coming down as major central banks have been diversifying into gold. But if you look at the blue line, in fact, the US dollar has been appreciating since 2015-16 onwards, where it was about 110 and it went all the way to 125 and now has depreciated about 4-5% in the last month. But what does that mean? It means that despite US dollar declining share in global FX reserves, the trade weighted dollar index has been going up. Dollar has been well bid across these economic cycles. And what happened in 2015? US got downgraded in 2015. So despite US being downgraded in 2015, the dollar actually went up. Secondly, what happened in 2015? 2015 was also the time when China started to meaningfully devalue its currency as it moved from a dollar pegging to a more basket-based currency management system. So broadly, as a result of all these two events, dollar actually has been going up, and it was only in the last 1 month that we saw some depreciation of dollar compared to rest of its trading partners, largely one due to uh, higher economic uncertainty, and also because people expect change in direction of trade, probably more towards eurozone than towards the US in the near term, which has led to this reallocation. But does that mean that you know US exceptionalism is fading? So on the right hand side of the chart, we can see the share of dollar in global financial system. So if we exclude gold, US dollar is actually 58% of foreign exchange reserves, which is followed by Eurozone, which is 20%, yen, which is at 6%, and RMB or yuan only at 2%. If you look at the international debt as well, 35% of international debt continues to be denominated in US dollar. If you look at international loans, it's much higher at 53%. Foreign exchange turnover, which is again 44%, and the global payment currency system, which is SWIFT, dollar continues to be around 50% of the global financial system. So, given these kind of trends, as of now, we do not see an alternate to the US dollar. We do think that probably the reaction in the US bond market and even the currency market is probably logical that there is a higher inflation expectation and there is also a higher uncertainty and there is a slightly better growth path which is being seen in the eurozone due to announcement of fiscal stimulus by Germany. But does that mean there is a secular trend which has emerged towards decline of dollar? That probably is, we would say, to be slightly cautious of. We still think it's early days. We probably, if US continues to remain uncertain in the foreseeable future also, and the growth differential that the US currently enjoys with the rest of the world, uh, that continues to shrink, then probably one may expect continued decline in dollar compared to rest of the world. But as things stand today, we do expect that dollar has a large role to play in the global financial system. And given that we do not have any major credible alternate, uh, we think that apart from gold and even on gold, there is only a limited amount of reserve that any central bank or any fund can buy, we do think that dollar will continue to be the dominant anchor of world monetary policy. And how global inflation is faring. So the blue line signifies the G20 CPI year on year, and the amber line signifies the Brent, and the gray line signifies the global food prices YOY. And as we can see, as crude prices have been declining, food prices have been declining, we are also seeing inflation coming down quite sharply in last 1 year. In fact, with the slowdown in global economic momentum due to the tariff-related uncertainties, we do think that inflation in advanced economies should remain moderate. But does that mean the central banks will start cutting rates immediately? While the growth outlook looks, downwards, and even the inflation looks to be moderate, we do think that the first order impact of these tariffs, especially in the US, may be more inflationary than disinflationary, and hence probably central banks, especially the Fed, may want to see stronger evidence of decline in growth due to the tariffs and the trade war, and hence we are likely to see more of back-ended rate cuts than front-ended on expectations of the declining inflation, and probably at least on the global side, you will have to be more patient in terms of more aggressive rate cuts from the Fed or from any other central bank. If you look at global bond yields, overall there has been a secular decline in bond yields, like we discussed. Given the tariff wars, there are concerns that probably economic growth for the next couple of years will be slower than expected. As well, the market participants are also expecting a positive supply shock from China that, probably we should see all the China capacity reroute towards other parts of the world, which will which may lead to some amount of goods disinflation, which is also again constructive for fixed income. So broadly, the last month has been quite positive. We do expect bond yields to continue to go down globally as more of those growth concerns come to the forefront, and we see continuous decline in global inflation. Coming to the financial conditions index, as we see on the left-hand side, the financial conditions tightened on the margin for the US compared to what we have seen in the last 1 to 2 years. Due to this tariff uncertainty, we saw some decline in equity markets. We also saw bond yields going, although marginally up in the US, but nevertheless, we do think that conditions will normalize as we get more clarity on the trade deals that the US is intending to make with the rest of the world, although it will take some time because right now the US is on a pause with respect to reciprocal tariffs, and probably as those deals get finalized, we will get and the market will get more clarity on how to move ahead with regard to inflation and growth outlook. But if you look at the market implied policy rate forecast, which is broadly calculated through interest rate swaps, which signifies 1 day overnight rate 1 year ahead. And if you see the delta from the month of March, market is expecting one more rate cut compared to what they were expecting in the month of March due to these uncertain policies. So now the 1 day effective overnight rate, which earlier was about 3.5, is now market is expecting around 315, 320, which is which is one of the lowest we have seen since the new administration came to power in November 2024. Now coming to domestic trends. So one of the very positive aspect that we saw during when we discussed global inflation was falling crude prices. So what does it really mean for India? So in fact, there was a RBI study which says that for every $10 dollar fall in crude oil price, it improves our current account deficit by 0.35% of GDP. So typically, if you see our current account deficit for the last 3-4 years, it has been between 1 to 1.5%. So that does mean the fall in crude oil price, keeping other things constant, should improve our current account deficit by 0.2 to 0.3%, which is quite constructive, which reduces our dependence on FPI or FDI flows because it automatically balances our current account. If you look at the GDP, the positive price shock, because we are net importers of crude, the positive price shock, even if the government were not to pass on the fall in the crude price, because ultimately then it goes as a higher excise duty benefit to the government of India. So because overall it goes as a higher benefit to the government of India, they are able to spend it on other avenues. It improves the fiscal position of the government of India, and hence it increases our GDP by 0.2%. If you look at the CPI inflation, of course, assuming a full pass-through, CPI inflation over a period of 1 year can fall by 50 basis points. But so far, we have not seen any major uh, passed through by the government, and the whole benefit is going towards the fiscal side. But ultimately, it benefits the raw material prices for many consumer companies, such as FMCG companies, consumer discretionary items such as paints. It improves the logistics cost, etc., etc. So on the second order impact, also we do some expect some benefit on the inflation side. So as we were seeing that, as I was saying that, overall improvement in excise duty helps the fiscal benefit. So as the RBI has quantified, every 1 rupee per liter hike in fuel tax adds to about 16,000 crores in government's tax revenue. So as we know, this time the government had, given some tax cuts at individual level. They had effectively made income of about 12 lakhs rupees tax free, which had resulted in about a 1 lakh crores of loss to the exchequer. And because of this, fall in crude price, we do expect a large part of it to be set off uh, from uh, from the benefit of this crude price, and hence we do expect fiscal to remain quite healthy for FY26. Uh, One of the biggest, I would say, points on, apart from the global tariff situation that we discussed, has been RBI's liquidity position. So as we know, while RBI has been cutting rates, it did cut policy rates by 25 basis points in February, 25 basis points in April. But one of the biggest changes that RBI has brought in the last 3 months is its position on liquidity. If you look at the kind of intervention that RBI has done, it has bought government bonds of more than 5 lakh crores in the last 5 months, which has been the highest since COVID, and almost double the amount, in fact, more than double the amount that was brought in by inclusion of India into the JP Morgan Government Bond Index. It has also added significant liquidity through its FX operations by providing FX sell by swap and also providing long-term variable rate repo options. As a result of that, for the first time, if you see the liquidity chart, after January, you know, uh, liquidity turned positive in it, and that has led to major, I would say, rally in bond yields, especially on the short end side, and has led to overall curve steepening. So if you look at system liquidity, it has been largely negative, about 1.5 to 2 lakh crores in the month of March. And if you look at the contrast in April, system liquidity surplus averaged about 1.4 trillion in April 2025. And if you look at the MIBOR rate as well, which was hovering, in fact, higher than the policy rate for the whole month of April, it has been lower than the policy rate of 6%. So overall, not only liquidity has improved, the improvement and the predictability of high liquidity has led to actual overnight rate even being lower than policy rate. So that has been very, very constructive for the banking system and money market yield curve. If you look at the credit deposit growth, we talked about economic slowdown in one of the previous slides, especially when it comes to overall global slowdown that we are foreseeing. If you look at even domestically, some amount of slowdown is also happening on the consumption side. So if you look at the credit deposit gap, that's also narrowing. So if you compare our credit deposit gap, which is the green line compared to the blue line, As you can see, the gap was really high during 2022. It started to narrow, but still the gap was reasonably wide in 23-24. But if you look at in 2025, the gap is closing, uh, very materially very high, and that signifies slowdown in consumption demand as well. So if you look at the non-food credit growth, it's now moderated to 10.2% compared to about 10.5 to 11% that we have been seeing in the last 1 year. If you look at deposit growth, that's also come to 10.2% compared to 11% in March. Although the deposit growth numbers fallen higher is higher. Typically, March deposit growth tends to be seasonally higher. So, but overall, I think the number that we need to really track is the gap between credit and deposit, which has been aligning and which is also signifying some amount of growth slowdown. And if you look at where has that slowdown really coming from, that the biggest contributor to this growth slowdown has been one NBFC credit growth. So if you look at NBFC sector, which is about 10% of overall credit, the growth has come below 6% compared to 15% same time last year. If you look at the unsecured loan, that moderation also continues. Now it's going at less than 8% compared to 15-20%. Even if you look at the credit card growth, that's now slowed down to less than 11% versus 16 to 22% we have seen in the last 12 to 18 months. So overall, credit growth continues to be slow, which brings us to the expectation that probably deposit rates at some point of time will also come down. So fixed income investors need to really consider their allocation towards other market-based instruments, which can give them some approval as well as mark-to-market capital gains. The other positive for banking system, apart from liquidity, was finalization of LCR norms. So as you can see earlier, the RBI in their draft guidelines had proposed an additional runoff factor, or that is basically higher HQLA assets to be kept for internet and mobile banking retail deposits of 5%. Ultimately, they were finalized at 2.5%. They had also proposed 100% liquidity coverage for non-financial wholesale deposits from trust partnership and LLPs, which were ultimately finalized at 40%. Even the haircuts on HQLA assets have been aligned with the LAF and the MSF factors which are run currently. And even the implementation date, banks have been given a meaningful amount of time, which is now the effective date for the new LCR norms is about 1st April 2026. So what does it mean for the banking system? So if the draft guidelines had been implemented, banks had to buy about 2.5 to 3 lakh crores of additional HQLA assets, which would have meant high credit quality CPs or bonds or government bonds, which would have led them to slow down on their credit growth. But if you look at the right-hand side table, because of these new LCR norms, the actual LCR for the whole banking system moves from 129 to 135%, and they automatically get a 2.5 lakh crores increase in SQL assets as per the new norms. So broadly, they have more space to grow aggressively on credit. So subject to demand from the borrowers, the banking system has now much more flexibility, much more space to boost credit growth and to boost overall economic growth. On the trade part, as you can see, the trade deficit widened for the fiscal year 2025 from 241 to $283 billion. One of the biggest impacts that you can see came from gold imports, which moved from 46 billion to 63 billion, and non-oil, non-gold imports from 500 to 534. In terms of oil imports as well, we saw higher imports from 179 to 186 billion for the full fiscal year. That was a result of higher volumes as well as lower discount from Russia. If you look at the export growth, that continues to be on the weaker side. So if you look at non-oil exports, that they just grew by 6%. And if you look at oil exports, they also fell quite sharply. So we don't really expect any material improvement as far as trade deficit is concerned for FY26 as well, given the kind of tariff uncertainty we are seeing for the world. But like we discussed during one of our earlier slides, the fall in crude price this year, if it continues to remain at current levels, will should definitely help our oil imports and should give some buffer on the trade deficit, and we should continue to see a very controlled current account deficit for next year as well. In the introduction, we talked about uh, geopolitical conflicts and how they behave or how they drive asset prices. Uh, One of the concerns for financial market participants has been, especially in the recent geopolitical conflict after the tragic terrorist attack in Kashmir on 22nd of April 2025, is that if geopolitical situation continues to escalate, what's the impact on asset prices? Of course, uh, we have seen ceasefire announcements between the two countries, and at this point of time, there is no major military hostility that we are seeing in India with other economies. But nevertheless, it's very instructive to look at the kind of market reactions we have seen in past military conflicts. So to assess that, what should be our really behavior, what should we do when such kind of situations arise? And as you would see from all these charts, we have tried to go back, almost 25 years. You've seen, we have, tried to analyze Kargil War, which was a full-scale war between India and Pakistan. And if you look at the other, geopolitical escalations as well, whether it was Parliament attack in 2001, the Mumbai terrorist attack in 2008, the Uri attack or the Pulwama attack, or even the India-China border tensions, we've seen that broadly markets have followed macro dynamics rather than really worry about short-term uh, impacts of these geopolitical escalations. So if you see whether in Kargil war or Parliament attack or the Uri attack, there was some amount of volatility very close to these events. But as you can see, ultimately bond yields followed the growth inflation dynamics over a medium to long term. So for example, the biggest example in this is the 1999 Kargil War, again, which was a full-scale war rather than a short-term military conflict. And as you can see, during that point of time, overall global inflation was coming down, global growth was slowing down, and India was also seeing slowdown in inflation and growth outlook. And as you can see, that the 10-year bond yield meaningfully came down all the way from 12% to 11.5%, post the Kargil war. If you look at the India-China border tensions, uh, the same thing flipped also on the other side. At that point of time, we saw the reversal of the COVID wave, and hence market participants were expecting stronger growth, and we were also seeing the impact of supply side shocks because of COVID and higher inflation. And as a result of which, we saw bond yields go up, not because of India-China border tensions, but because of higher inflation due to supply chain related issues during the first wave of COVID. So it was again macro dynamics, whether you look at 99 or 2021, or we do expect even in the near future, it will ultimately be macro factors which will drive the bond markets in the medium to long term. So from an allocation standpoint, we think that investors should stick to their long-term view and not worry about short-term volatility when they look at any asset allocation. The other part, positive part, which is also driving our fixed income view is, the high dividend that we are expecting from RBI to the government. So as we know, every year RBI announces dividend to the government of India. depending on the profitability of the RBI for that particular year. And we do expect RBI to make record profits in fiscal year 2025. The reason was RBI's FX sale to support INR and to prevent INR volatility. So as we can see in FY25, and these are internal estimates, so as we can see, RBI's overall FX operations were even double of what we saw in FY24, because in FY25 we saw huge amount of volatility in the INR market due to FPI outflows. But because as RBI follows cost-based weighted average system for FX reserves, and as it made the sale at current prices, we do expect RBI to have made a reasonably high amount of profits. And we do expect RBI dividend to the government in the range of about 3 lakh crores, which will also result in higher liquidity in the next couple of months in the banking system, because as RBI dividend goes to the government of India, the money goes from RBI account to the government account. And as the government starts to spend that dividend money, it comes back into the banking system and it leads to positive liquidity. This high dividend also uh, very constructive from a fiscal standpoint, and it gives a lot of fiscal headroom to the government, in this kind of economic uncertainty, without impacting overall bond. Coming to the shape of the curve, as we can see, especially if you look at these spread slides on the bottom chart, you know, the bond yield, especially in the 3 months all the way till 5 years, they fell down much more, thanks to easy liquidity and rate cuts by RBI. We had discussed this before as well, that we do expect curve to steepen, because as liquidity comes back into the banking system and as RBI cuts rates, it's a short-term yield curve which will benefit the long end, because the long end had already priced in the expected monetary easing from RBI. Typically short end of the yield curve, or even the medium end of the yield curve, they usually tend to rally at the actual rate cuts, whereas the long end, you know, they behave in anticipation. And as the market was anticipating more rate cuts, the long end had already rallied last year and the early part of this year. But it's the short end which has started to rally now, and we do expect short to medium end, which is basically from 3 months to 5 years, to rally in terms of basis points in greater numbers in the next 3 to 6 months. So this is just a number depiction of curve across T-bill, AAA, and AA segment. So as we can see, there's been a secular rally across, whether it's 1 year, 3 year, 5 year, or 10 year. But the rally in the 1 or 3 year space has been much greater in the month of April, thanks to easy liquidity by RBI. So broadly, what does it mean for our investors? So if we look at, again, from a inflation standpoint for India, overall moderation in domestic growth, and we are also seeing a period of easing food inflation. Like we saw in one of the previous slides, even the global food prices continue to be on the lower side. We are expecting a normal monsoon this year, and which should lead food prices to remain well controlled. What does this mean? This means that RBI should have now a greater confidence that inflation should align to its 4% target over the next years. On the growth front, like we saw in our various data points, global growth momentum continues to slow down due to the tariff-related uncertainty and overall trade fragmentation that we are seeing in the global economy. It also does affect India through its export channel, and overall reinforces a constructive fixed income outlook environment. The third part, you have a stable inflation, a moderating growth, and on top of it, you have an easy liquidity environment in which RBI is committed to provide, and they have said that they want to maintain liquidity at 0.5 to 1% of NDTL, and if they want to support growth, they may even go higher. What does that mean? That they will continue to do more open market operations, which should put a cap on the rise in bonds. And so broadly, what it means for us as investors is that liquidity is expected to remain easy. We do expect more of 50 basis rate cuts in this monetary policy cycle. So overall, if you look at fixed income funds, although we have seen some rally in bond yields, we have seen bond yields going down, but we do expect bond yields to further go down as RBI cuts rates by 50 basis points and continues to provide easy liquidity. The second part, if you look at alternates, like we discussed, as the credit deposit gap narrows, we investors should expect lower rates on their fixed deposits as well. So from a relatively speaking, one has a opportunity to lock in better real bond yields on debt mutual funds. There is also opportunity of mark-to-market gains. And if an investor were to consider a fund of fund structure, then even a post-tax return for that fund can be more superior than traditional fixed income instruments. So overall, we continue to think that this is a constructive environment for fixed income, and investors need to plug in their reinvestment risk as we see more of economic easing going ahead. That was largely from my side. We're happy to open the floor to questions. Thanks a lot for listening. Thank you.
Thank you, Anurag, for the insightful presentation. We will take the questions from here. So the first question is, given the economic growth slowed in the Q1 in US, consumer and business sentiments continued to worsen. Several firms have raised the estimated probability of economic recession in US. So what are your views and the possible impact going forward?
So I think we do expect moderation in the US growth outlook for the next 6 to 12 months. So there has to be a distinction made between a recession, which is a significant growth slowdown or two consecutive quarters of negative GDP growth, and probably a slowdown from the current levels. So right now, our base case is US economy or the global economy may see moderation going ahead because overall global export cycle may see some headwinds in the near term. But we do not expect it to be a full-blown recession, as we do expect the benefit of lower, uh, you know, inflation in rest of the world. We do see benefits of some amount of business deregulation in the US, and we do expect that the tariffs which were announced on uh, 2nd April should be scaled down subsequently. For example, you saw during early part of April that US announced 145% tariffs on China. But if you look at the recent trade negotiations between US and China, they have reduced those tariffs all the way from 145% to 30%, right? So there is a lot of negotiation which is happening, between US and other trading partners. So we do expect that the final tariffs could be meaningfully lower than what they were announced in early part of the April. They are probably part of a negotiation tool, and hence we do not expect any durable and I would say long-lasting impact on growth, which leads growth to a negative slowdown. We do expect some moderation, but we really do not expect a recession for now.
Thank you, Anurag. So the next question is from Mr. Deepak Gupta. So this is a slightly elongated question. So I'll just quickly brief. The rate differential between that of Fed and RBI is at its lowest. The Fed, despite the pressure, is not in a position to lower the rates in view of present inflation and anticipatory inflationary pressures due to tariffs. To what extent can RBI lower rates and expect foreign flows, keeping in mind that they also need to hedge their investment with respect to currency fluctuations?
That's a very good question. I think the relevance of the US, especially for Indian context, at this juncture is quite low. So if you, like you rightly alluded to in your question, US is facing its own peculiar problem of a slowing growth, but also rising inflation expectations due to the tariff concerns. Whereas in India, if you look at how inflation has been behaving, and especially if you look at the nature of inflation in India for the last 24 months also, In the last 24 months, the biggest contributor to inflation has been food inflation, which has been high due to erratic weather patterns and lower rainfall. But as we expect normal monsoon this year and overall global food prices are also on the lower side, we do expect inflation to remain close to 4% for the next 12 months. So US is facing higher inflation than their central banking target for the next 12 months. India is facing inflation which will probably be closer to the central bank. So I think at least it's probably not the right comparison. Even if you look at FPI flows in the Indian fixed income, they have been quite uh, positive if you consider the last 12 months. So unless and until let's say we see any major upward pressure on inflation, which changes the central bank expectation trajectory for Indian fixed income, we do not think that the we should worry about the gap in the near term.
Thank you, Anurag. Very well answered. There's one more question from him. On one side, the world is facing deflationary pressures to anemic growth, which requires central banks to lower interest rates. But due to increasing cost, due to supply chain disruptions, inflation still is above the comfort levels the world over. Increasingly waging of wars resulting in the less availability of funds for social welfare and straining government debt. Will all this not make cost of funds go up despite being in a deflationary scenario? Please give your assessment for 1, 3, and 5 year perspective.
It's, I will say, to give a very long-term forecast of uh, global inflation or global growth, it requires us to make certain assumptions regarding taxation, regarding tariff, and the biggest one being productivity. So one of the major reasons for disinflation in the 90s and early 2000s was entry of China into WTO, which basically plugged Chinese manufacturing capacity into the rest of the world and led to overall slowdown in manufacturing inflation and decline in inflation expectations. And for a long period of time, the Fed was facing a problem, especially after the global financial crisis in 2008. That despite record injection of liquidity, there was no major pickup in inflation. The reason being increase in global productivity due to inclusion of China in the world economic system. Of course, now the benefit of all of that has been played out, and we may not see incremental benefit from addition of China. But what are we facing? So we are facing competing pressures on inflation and growth. So if you look at the, for example, demographics, so apart from probably India and some parts of Africa, the overall world faces, weaker demographics. You have aging populations. What does that mean is, a lower consumption and hence lower inflation. On the other hand, like you said, you're also facing trade issues, trade wars, which is probably resulting into higher tariffs. But the important thing is, can they be really passed on to consumers without causing a meaningful demand side disruption and hence a meaningful growth slowdown? Probably not. That's the same thing which we saw in one of market implied rate forecast, in which market participants are in fact expecting in aggressive Fed easing than they were expecting in March, because they're also expecting that probably the world is not in a place to withstand all these tariffs. So ultimately, it's a zero sum game. If you are taking taxes from someone has to pay for it, and overall their consumption basket will go down. So while the taxes may increase in the near term, but from a medium term perspective, they are a drag on consumption, and hence, from a medium term perspective, they are not really inflation. If you look at the GST, for example, imposition in India in 2017, what did the central bank said and did? The central bank considered GST as a one-off event. It did not really hike rates because of imposition of GST, because ultimately any tax is a drag on consumption and a drag on inflation in the near to long term. So that's one, I think, aspect which we should think about, that due to aging demographics and overall weakening, uh, global growth, we ideally should not expect very high inflation in the medium to long. The second part, which we should also think about when we are thinking from a 3 to 5 year view, again from a fixed income asset allocation, is due to now advent of artificial intelligence, we should expect pickup in global productivity growth, and we should expect some amount of slowdown in inflation as well. It's very difficult to quantify the impact because things are in very early stage. But since we are taking a 3 to 5 year view, probably we should also take into account some of the benefit of productivity that we will see from that aspect. So overall, from an inflation standpoint, we do expect inflation to remain overall moderate in the medium to long term, and I think that's something which should be driving our fixed income allocation as well. Thank you.
Thank you, Anurag. One last question. So now, while we are recommending moderate duration categories, now since there are multiple categories that follow moderate duration strategies, either by mandate or with some flexibility, given the current market dynamics, which of these would be most suitable based on the spectrum from lowest to highest risk appetite?
So again, like you rightly said, it depends on investors' risk appetite and also depends on the investment horizon. So for investors looking from an allocation for 6 to 12 months perspective, then probably an investor should be looking at a money market or a low duration fund, which typically maintain a duration between 6 to 12 months. Uh, and they should benefit from the easing rates, as well as some uh, higher accrual what investors can typically get uh, when they are looking at liquid fund relatively. If an investor has a more than 1 year investment horizon and they have appetite for some amount of mark to market volatility within UTI stable, we recommend UTI corporate bond fund, which is a 100% AAA oriented or a quality oriented corporate bond fund with some allocation to government bonds and high quality corporate bonds. Investor can also consider UTI short-term fund, which maintains duration between 1 to 3 actively and has a combination of high-quality corporate bonds plus some exposure to government bonds. For investors who have the flexibility and mandate to invest in the fund of fund structures, we also recommend UTI income plus arbitrage fund, in which about approximately 60 to 65% should be invested in debt products such as corporate bond, short term, etc., and the rest will be invested in the UTI arbitrage fund. Uh, so that if the investor would stick around in this fund for more than 2 years, the investors, as per the current taxation norms, are subject to 12.5% taxation. So from a post-tax returns perspective, this product is also suitable for conservative to moderate investors because the fund manager has the flexibility to reduce duration in uncertain or volatile times. So overall, this fund is suitable, I would say, to investors who are happy to hold fixed income for more than 2 years.
Thank you, Anurag. This, I'm sure, will give a very good clarity to the investors. We will conclude the discussion here. So, thank you everyone for joining us today. We hope the insights shared by our expert has given you the clearer understanding of the current fixed income market and the opportunities ahead. We encourage you to continue the conversation and stay connected for the future updates. Until then, stay informed and stay ahead. Thank you for your attention.
Thank you. Thanks, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.